You are a verified 8-figure trader with Trillium. You trade from the 2-minute intraday chart. Many would hear that and say, whoa, that's gambling.
I would say on the smallest time frames, sometimes offers the most edge. And the longer the time frame you go out, the less edge you have.
What kind of size can you put on those opportunities?
You can make hundreds of thousands. I mean, there's going to be some headlines where you can make $1 million plus. In my experience working with a lot of traders, I would say I've probably worked with, 200, 250 plus traders at this point. I've not seen anyone that matches the edge of shorter time frame trading.
In this episode of The Way of the CPT, we have Lance Breitstein, a verified 8-figure trader who worked at Trillium, one of the longest standing prop firms, where he broke multiple all-time profit records. He led their Chicago office for years and trained several classes of traders. He is known for transforming traders from good to great and elevating those who are great to elite. He is currently an advisor for the prestigious SMB Capital and the founder of the Impact Competition. Lance shares how he made millions from the 2-minute intraday chart, how to find edge in different markets, and how elite traders are made. Without further ado, let's talk to Lance.
Welcome to another podcast episode of The Way of the CPT, the Consistently Profitable Trader. We have a very, very special guest today with us. We have Lance Breitstein. Thanks for joining. If you've been following the channel and the podcast, you know I always start off with a quote from a book or a prolific author. So today I'm going to start off with a quote from Tim Grover, who trained both Michael Jordan and Kobe Bryant, both elite athletes. So Tim Grover, he says, interested people watch obsessed people change the world. You can't be interested and obsessed. Interested is a hobby. Kobe Bryant wasn't interested in winning championships. He was obsessed. And obsession comes in the small details that nobody is concerned about. The reason why I read this quote is because I really admire the level of detail that you talked about when you discuss trading. You know, some of the achievements that I just kind of want to read for the audience is that you are a verified 8-figure trader with Trillium. You ran their Chicago office for many years. You know, you saw many traders coming in. You trained many traders. You are an advisor for SMB Capital, one of the top prop firms, top proprietary firms in the country. And you run a small nonprofit right now. My audience consists of traders who they are interested in getting funded. It's the independent trader that's trying to make a living, trying to quit their job, become a professional trader. So a lot of what you do in the field, like when it comes to tweeting, the YouTube videos that you put out, it's a big help because you've exposed to us what it's like to be a prop trader, what it's like to professionalize the trading business, man. So the audience has a lot to learn from you. I have a lot to learn from you, and I'm sure you have a lot to share, man. Thank you so much.
Yeah, and first, I love that quote. Tim Grover, he has some amazing books out there, and especially as we record this in the land of Kobe, R.I.P. I think it's a really good concept, and I think a lot of what makes people great and what makes those two guys, Jordan and Kobe in particular, so great is you need to not be focused on the outside world and what others are doing. It's a lot of internal, like that obsession on the process and on winning, that's all pointed inwards. And I think if you're trying to be truly great, and not everyone needs to do this, but if you're trying to reach that prolific level of success, when you're at that stage of the game, you're not worried about this player or that player, what they're doing. You're not comparing yourself to others because you're trying to just elevate your own game, and you're so focused on yourself and that's the only way to do it. And so recently we just had our kind of elite top trading psychologist fly out here for a whole weekend together, and that was one of the big things we spoke about is how important it is to not play that comparison game and just to focus on yourself and improving your game and being better every day for you.
That's so important. So we'll talk a lot more about it, but you've made a big mark on the YouTube space, social media space. But I don't think a lot of people know about your upbringing and what drives you. So do you mind telling us a little bit about your background?
Yeah, sure. So originally from New York City, have a twin brother who now is out in Miami, and grew up, I would say, just like a kind of typical blue-collar family, and every blue-collar family had their money struggles. And so while we kind of hopped around a little bit, especially in around 2008, we were right outside New York City in New Jersey. Then you get the great financial crisis. Everything, of course, goes to shit, especially anything that's tied to New York City. So then you just see your parents struggle and you get driven and you say like, okay, like I don't want to worry about this stuff. And what was so interesting talking with Dr. Katz, that trading psychologist, is like the psychology of money and upbringing is just such a fascinating topic.
Yeah.
And you have people like the author Morgan Housel wrote this book, Psychology of Money, which is just so many great stories and so many fascinating things, because like the forces behind money and our upbringing drive so much of who we are, right? Like what do we value in our identity and a career as a person?
Yeah.
It's a way different person that gets into social work versus the one that becomes a trader and is so motivated and driven by these factors.
Yeah.
And I think asking about upbringing is so important, because I think not just in trading but in anything, a lot of the people that really have kind of like that excessive drive, like if you look at Elon Musk or all sorts of people, like the Wall Street Journal even did a study and found like of the mega achievers, so many of them had some crazy upbringing, and that really motivated them to kind of push through the suffering and the disaster that reaching that level is kind of associated with.
Yeah.
Whether it's like Oprah Winfrey to Elon, or at a much smaller scale myself.
Yeah. What were your parents' expectation of you? Were like you expected to go to college or like be an entrepreneur?
Thankfully, my family, especially my mom, really did stress education, where they never really went to maybe just like the associate's degree or whatever. And it was like, okay, like, you guys are going to go to school, you're going to get a good job. And it was just a different expectation.
Yeah.
And so what's super funny is I think I graduated high school maybe 30th out of like 180 or something. So nothing so particularly impressive. But then the second I got to college, I think it was just that switch just flips on, where it's like, okay, this is real, this matters. Like if I need to get a good job out of here, and especially then, like I said, great financial crisis happened during my college career, and it became very clear, like, okay, the second I get out of school, like I better figure my shit out, because family doesn't have money, I've got student loans, things are not looking good out there. And once that switch flipped on, like it was just go time, and I worked my ass off in school. And so I ended up graduating, I don't even know anymore, but I think I was maybe like third out of like 3,000 people or something, couple thousand people out of Indiana. Even as far as the process of applying for jobs, I took that thing to a whole new level, where I had my spreadsheets, I did all my research, I was networking. And I remember even in essentially the post kind of graduation time, one of the professors that was running the Wall Street program kind of just took me aside and said like, hey man, like props to you. I've been running this program a really long time. Nobody did the hustle you did. And what's so funny is as we get to the Trillium stage, is Trillium back then was paying $26,000 a year.
Wow.
And so many people are like, man, like I had some offers from some of like the bulge bracket banks and stuff, go do sales and trading. And so when people were like, what, dude, like you're turning those jobs down, you're taking like $26,000 a year. And for me, it was just a no brainer, because I'm like, no, it's not about what I'm going to be making next year. It's if I do well, and if this clicks, like this is the path to far greater success, and success on my terms, because I'm not the type of person that wears a suit. I don't like bureaucracy. I don't like the bullshit.
Yeah.
I just want to play the game and try to be the best at it.
I think some of us have seen the video of you introducing Mike Bellafury. Right?
Yep.
You're in a suit. He's in a suit.
That will
when
never
did that
be seen
happen?
again. that year, I wonder myself what year that was. That might have been around 2010.
Man, that's pretty awesome. So as you approach your senior year, you made a decision to go into day trading instead of going to work for like maybe a larger bank. How did you know that potential upside of that job?
Yep. So I think there were a couple important influences that happened, and we were even talking over a little lunch before this, and we both read the Market Wizards book, and so those books, that whole series really inspired me, and it got me so interested in just beating the game, and like how do you, through different strategies, different skill sets, there were so many different ways to kind of beat the market, and that appeal of can you actually do it? Can I do it? And so when I learned about the different firms, I knew I wasn't a quant, like good at math, not Rain Man. I knew I wasn't a programmer. I had some programming skills, not, Zuckerberg, despite the resemblance. That's what I always get. It's either, you want to know what's so funny? Obviously, you knew I was a little sick, and one of the nurses is like, oh my God, it's Mark Zuckerberg. And I'm like, Hey lady, you think if I was Mark Zuckerberg, I'd be lying here right now, like slowly dying a lonely death.
Yo,
And
that's funny, man.
it's either Zuckerberg or Channing Tatum or like a Matt Damon, as you can
Matt
understand.
Damon.
Yeah. And so I didn't have the programming skills, and so what I really felt is I just have the soft skills, the more qualitative stuff. Like I'm going to outwork, I'm going to outcompete, I'm going to be more resilient. If anyone out there can do it, I can do it.
Yeah.
And it seemed like, okay, I'm not going to end up at the Jane Street Capitals, the D.E. Shaws, the Citadels, but there is a little space that likes hungry people, and that happens to be just the discretionary intraday trading.
Yeah.
And so I kind of compiled that whole list of firms, and I knew where my skill sets aligned, and Trillium was one of them. And the biggest question for me was, I don't care about the entry salary. I don't care about the 26K. What is the probability of success, right? I understand it's a high failure rate. Not everyone's going to succeed. How many people do succeed? And of those that succeed, what is that spectrum of success look like?
Yeah.
And so with any of those bulge bracket banks, you can chart super easily. Obviously, salaries, bonuses have changed over time, but you knew year 1, year 3, year 5, year 10, year 15. That's what it all looks like down the road, which was great. For many people, that's incredible living, but it just wasn't my style. It wasn't what I was interested in. And so then I knew, like, look, you're going to eat shit for a couple years, but if you happen to be one of the successful ones, the sky's the limit, and you can do so much better, so much faster.
Yeah.
And true to as advertised, like at Trillium, you have a bunch of guys in the top 10 each year, where these are young guys, like late 20s, early 30s, that are making $1 million plus, couple $1 million a year. Eventually, every decade you get a Kobe, you get a Jordan. And so I just knew, like, wow, there's no other path like this, doing something that seems so cool to me.
Yeah.
You go on the trading floor, and their New York trading floor is massive, probably, I don't know, 80 to 100 guys there. And you see just the rows, well, maybe less now, post remote and all that, but you see the rows of people and the energy. Everyone's super casual. Everyone's fooling around. It was like just a little frat house. And I'm like, okay, like this is where I can be in a fun atmosphere, and I'm going to have my fun, but then I'm just going to outwork every single person here.
Yeah. I heard you say that for the first 2 years, you weren't profitable. When did you become obsessed?
I mean, I was always obsessed and driven. Like, I just had such a chip on my shoulder back then, where it's like, I was a smart guy, wasn't able to get into any of the Ivy Leagues, crushed it at Indiana, wasn't able to get into like the Goldman Sachs or any of the really good places. It was one of those things where it's like I just I thought highly of myself and had confidence in myself, and I knew that I had potential. And it was one of those things where it's like, okay, like, if they're not going to let me in the best place, it's time to just, break this whole thing down. And it was just like, look, I don't care who else is in this training class. There were people from the Ivies, there were people from all over, but it was just like, I'm just gonna outwork every single person.
You're a killer, man.
And trust me, man, there was nobody. My work ethic was unbelievable back then.
You're a killer.
Even in school, like I was working during school, I was tutoring, I was doing all this stuff. And like the amount of hours I put in, and then when I wasn't doing the hours, I was reading the trading books, I was trading the fake accounts, I was learning about technical analysis, and I was doing all this stuff just because I just knew it was game time. And
So tell me, what was your first like breakthrough? Like, okay, I'm eating shit, I'm failing, I'm not making it, and you also had one of the greatest like traders as a trainer.
Yeah,
at the time
this
as well,
guy
right?
was super incredible dude, and so this guy, without proper mentorship, I really think you have the odds so stacked against you. Even with good mentorship, the odds are stacked against you. So I got lucky that this guy was nearly, there were two of us, so he was training us super, super direct, and I still struggle. But the thing that started to click, part of the issue was everything was just so fast. And even though this guy he developed all these strategies, he was incredible, but he didn't really have a super efficient process for teaching it. Like a lot of the stuff I specialized in the end, like how to learn and how to speed up learning. Because when I ended up training so many people and running an office, it was the meta learning of how do I get these guys better? How do I improve as quick as possible? And so a lot of that came from my own. And so it was just drinking from the fire hose. And it was, dude, like, come on, man, like this isn't that hard. Why aren't you able to do this? Why aren't you able to do that? And you're like, holy shit, like my head's spinning, because every trade, they're never identical, but they rhyme, and all the variables are different. You get so stuck inside your head. And so finally what started to happen is I started to isolate what I now call like the easy money trades. Super replicable, ideally slower. Like some of the breaking news stuff can be super, super fast. Let me find the trade that's slow. Let me find the trade that's simple. Let me find the trade that's replicable, and kind of just like the layup or the foul shot. Like what's the trade that I can really hone in on, and just hit my little single, and hit that little single, then size it up a little bit. And if I made $100 before, I want to make 120 the next time. I want to make 150 the time after that. And so I really, really started to focus on those. And so I was still losing money for a really long time because everything else I was doing, like I almost envision it. Imagine you're trying to build up 10 different strategies. I was a 1 at each of these. And so you might get a couple green shoots in some of these easy ones, but then you're still losing money in the other places. So you wouldn't really see the progress, at least in the P&L data. But I knew like, oh, wow, like I'm starting to at least get some of these trades. And then what I also recognized, and this was super important, is yes, I only made $100, but that trainer, that dude sitting next to me, he might have made $2,000 or $5,000 in that. And so I just would always say to myself, even when I was really struggling and things, it was looking like I might not be able to do this, I just knew like, Lance, like even if your playbook is 2 little trades, but if you just become the master, there's almost like the Bruce Lee line, the master of one punch who's practiced it 10,000 times. And it's like, if I can just find these couple little things, and if that guy can make $5K in that trade, even if you do the math, like if I just have one of those a month, I'm probably at least making a living if I ever get to that stage. Then if I even get 2, oh my God, the thought of ever making $100,000 doing this job that I loved was like, I didn't ever want to make a ton of money. I just wanted to not get fired at that point, you know?
Yeah.
It was like, because it's different than the retail side. On the retail side, you're on your own timeline. For me, it was just like, man, this is the dream. I see what the people around me are making. Like I saw what my boss was making, I saw what the other people in the group. And there would be some days where your jaw would drop, right? There would be days where the dude next to me would make $100,000, and you're like, man, that's more than my family makes in a whole year. And
what was the runway that you had? Like how much runway, like how much time did you have to become profitable?
So
like,
that's the good thing about places like Trillium or SMB is they give such a long leash. And as long as you're really showing effort, I mean, I don't know how much money I was down. I was probably maybe down, and I mean, it's so long ago and I don't have the data, but I was probably down maybe like 40, 50, 60K, 70, 80K, maybe even over like probably a peak trough or whatever over the first year or two. And what's nice is they really, my heart was in it. I wasn't doing anything negligent. I was really trying. The other thing that gave me a lot of comfort is here's the reality. Even though things look scary and like sometimes HR would have a little talk with me like, hey man, how can we better support you? You're not really making the progress you need. And so what's interesting is I probably started in a class of 25 people, and you would see people start to drop like flies. And not because the firm fired them, but just because it was like super difficult and they were losing faith in themselves. It's been a year they're not getting paid. It's been a year and a half. And for me, it was like, oh man, like I need to get paid at some point. Like I've got student loans and everything else. But I'm, until then, like it's just go. And what ended up happening is like things finally started to click and they gave me the time I needed. And then I also knew, at least in my head, I was smart, right? I recognized I'm not making any money, but I understand things well enough that I'm making call outs. I'm studying projects and like I'm contributing value to the group. Mm-hmm. And like I talk about this concept about trading pods, right? And linking up with other traders. And people might think they don't have anything to add value to more experienced traders, but you're just not thinking hard enough, right? Mm-hmm. You can help with watch lists. You can help perform studies. You can help with back testing. You can help with reading the news, finding different news sources. There's so many different ways to help. And so the thing that I did best is obviously I was trying to improve my own trading, but what I also was doing is I was helping other people like spot the opportunities we were looking for. I was doing different studies. I was coming up with ideas. And so guess what? My salary back then was $26,000 a year. They're not going to fire me if over the course of the year I'm making the people around me so much more money from call outs and everything else. Yeah. And so that's the thing where I'm like, yes, I'm feeling a little bit of pressure from up top, but like I think I'm good time wise because like they kind of be crazy. I'm helping these guys spot opportunities where they might make $20,000, $30,000, $50,000, whatever. And sure enough, like especially come that year 2 mark, things had really turned around in a big way.
Yeah. So when did your personal playbook sort of come together and you start to like dig yourself out of that 60K hole? Right.
Well, the funny part is, and I think this is the right way to think about it that people forget, and this actually came up I was advising a trader that actually got ripped in ZJYL, and he wasn't sure, like, man, is trading still going to be right for me? Like, am I just worth getting out of the game? And the thing is most people think linearly, years in, and he's like, oh man, like, am I still gonna, if I made 100K this year, then lost 50, like, it's gonna take me half a year to get back. And it's like, no. This stuff's not necessarily linear.
So did you have like a big monetary win like that really gave you that boost of confidence?
There was one trade that probably kept me from staying off the ledge. I mean, I got lucky in two ways. So first was I interviewed for D. Shaw, who then rejected me, and thank you. And then the other thing was shortly after that, when I was still interviewing at other places, there was this exhaustion gap set up in Tesla. And that was a pattern where I had seen it a bunch of times. This was something my trainer really specialized in and loved. And it was one of those things where it's like, okay, Lance, like, you can, like, any trade that you can kind of game plan for and be proactive about, that's a major help. And so even pre-market, I was like, I knew the reality. It's like, Lance, like, you might not have more than 3 more months, 4 more months, 6 more months here if you don't make something happen. And it's much like in poker when your stack is getting small, right? Like, you say, like, again, not all-in's not the right analogy. I wasn't doing any of that crazy stuff. I wasn't doing anything negligent. But it was like, look, this my time is winding down. When I get something good, I need to kind of make a stand for it. And in this trade, I ended up making like 10 grand that day or something.
Yeah.
Which my normal good day was maybe like 1,000 or 2,000.
Okay, so you're 10x.
And so then it was like, wow, like, holy shit. And it was that realization that, like, if I can do that, I can do anything now. Like
yeah.
This setup will occur again. And if I just stick around and bide my time and eventually get higher buying power, higher lockout, higher share size, like, I mean, I think my boss made like a couple $100,000 that day. And it was just recognizing, like, wow, all I need in my life is just survive, Lance, and be there for some of this.
All right. So most of the traders listening, they want to become consistently profitable. What is a consistently profitable trader, like, from your perspective?
Sure. And I think certainly that doesn't mean you make money every day. I don't think anyone needs to do that, right? Nor will they ever. And I don't think people even need certain profit targets or anything like that. Like, the way I look at it is, are you having green months? And are you reaching a level of consistently green months? Not that every single one is green. Like, I think maybe I had a couple trading years with no red months. But even in my later years, I was still always having the occasional red month due to some outlier or something gone wrong, or just like a slower period. But I think the most important thing is, are you consistent enough where you're able to capture the easy money trades in your playbook? And then are you able to just cover whatever that base need of income you need? Once you're in a position where you can cover your needs, then you're in the driver's seat.
Yeah.
And that's when you can really scale it. When you're no longer like thinking, oh my God, if I don't hit this trade, or if I mess up this trade, I'm not going to be able to pay my rent. Once you're past that stage, and once you have some acorns saved up, that's when you can really say, like, okay, it's go time.
Yeah.
But the foundation of ever getting there is consistency.
Yeah.
And so many people look at the home run traders, whether it's on Twitter or whatever else, and they don't realize the only reason why those traders are able to swing big, or even how they got there, it all starts with the foundation of being able to consistently perform in the easy money trades. Like if take any star basketball player. If they couldn't hit the easy shots, no way would they ever be on that court to ever take that game winner.
Yeah.
And so people only focus on the fadeaway jump shot at the buzzer, but it's like, no. The only reason why they're ever on that stage at all is because of their easy money trade game, and just being able to do the consistent stuff prudently, safely, and put up those singles.
So, all right, for the audience, I was born and raised in the Forex community. So came through different like multi-level marketing companies and worked my way through different academies. So
Herbalife, Cutco. No,
yeah. So I feel like I have my ear to the streets. I know what people are struggling with, right? And meeting Mike Bellafury and some of the other like professional prop traders, the idea of the playbook and edge is a conversation that is missing in like the Forex space. A lot of traders in the Forex community, when they think of consistency, and they think of psychology, they think of execution and risk management. I want to read a tweet from you, which really caught me off guard, and it stuck with me, and it impacted my career. So you said, my number one fin twit observation: Most failing traders wrongly attribute their struggle to issues of psychology and risk management. Reality is most have zero edge. They are naively fooled by randomness into thinking their wins are edge. This seduces them to troubleshoot the wrong problem. Now, this is powerful. It's a powerful statement. Can you talk to us about like what is the definition of edge?
Yep. So edge at its core is essentially, do you have positive expectancy? When you take that trade or when you play that hand in poker or when you roll the dice, in the long run, will you make money doing that? And so what so often happens, right, is if I were to give you a coin, for example, and I said, okay, flip it. Most people, we know a coin is 50-50 and it doesn't really matter how you flip it. But if we were to play a little bit more complex of a game, you might think, let's say it's like stop, you got to press the buzzer to align the lights or something. You might think, oh wait, the pattern is the second the light turns red, I need to press it as quick as I can. And sometimes that might work, sometimes it won't. So then you're like, oh crap, like maybe this isn't it. So the times that it does work, you're going to say, oh man, I got that timing just right. I did this right. I was in the right headspace. I was focused. Then the times where it doesn't work, you're going to say like, oh man, like I lost my focus. Like I was on tilt or like I got in my head. And so often what happens with trading is I'll see people where anytime they have a good trade, they attribute it to like, oh, you know, skill, whatever else, blah, 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 blah. But then like they'll have some positive streaks, which are inevitably going to happen. Like if you were to flip a coin 10 times, imagine if every time you got heads, you're like, oh man, like that was great. That was great. That was great. I'm doing everything right. I'm a really good coin flipper. Then you're like, oh man, next time I get tails, oh, I was overconfident. It's like, what? No, it's just you're flipping a coin. And so I think people get fooled by that a lot. So often it's not like, you need to either have back-tested data or you need to have some form of data to know that like, oh wait, my odds are better than break even here. And so a lot of people just don't understand that concept. And it's so important because essentially if you're playing that coin flip game, it doesn't matter. You can flip that coin till you're blue in the face. That's still going to be 50-50. If you're playing that slot machine, you can figure out like, oh no, I gotta pull the lever this hard. I gotta do it from this type of angle. You can try those games until you're blue in the face. It's never gonna work, right? But what you do need to say is, okay, if I go to the poker table, now there's not every hand, right? And this is important in trading. Not every ticker has edge, not every situation. I can get pocket jacks one hand, and that can be a totally shit hand, right? Depending what's on the board in the context. And most hands that I'm dealt in poker are going to be totally useless. If I play most of my hands, I'm going to lose. No matter how good of a poker player you are, if you play every hand, you're going to lose. And it's the same in trading. But what happens is there's very, very specific hands, not just specific hands, but the hands need to be in very specific situations. What are the other cards on the board? How are the other players acting? Then I need to bet and fold and do everything appropriately. And even when that happens, it's still a probability focused game.
Yep.
I can play aces, I can bet properly, I can do everything right, and I can still lose. And that's fine. But that doesn't mean I didn't have positive expected value. So the same analogy is like you need to find the right tickers, and not just the right tickers, but you need to find them on the right days. You got to trade them in the right way. Then that's where like psychology and risk management can help refine all that. And you still got to execute. The best analogy I can give people is if there's a system with incredible edge, like if there's some slot machine where you win 99% of the time and the win-loss ratio is 5x, there's no way you're going to mess that up, right? It doesn't matter if you go on tilt. It doesn't matter anything. Like you can tweak the odds in one direction or the other. Your edge is still so great that overall you're going to be winning. And so what I saw is my trainer, his strategies had enormous edge, but he was far from perfect psychologically with risk management and everything else. He would definitely go on tilt. He would definitely average into losers. He would definitely sometimes get totally run over from trading without a stop. He would make some major mistakes. But because he had so much edge overall, a lot of that stuff got overshadowed. Yeah. And so like, I'm not saying psychology or risk management aren't important. Of course they are. But above all else, you need edge first. Then with more experience, those become more important because psychology and risk management are what allows you to keep on playing that game with the edge and prevent you from taking situations that have negative edge.
Let's take a small break. As Lance mentioned in the podcast, edge is the foundation of successful trading. This is why I like to tell you about TradeZella. It is the best software to help refine your edge and find your best setups. It makes it easy to create a digital playbook where you can detail entries, exits, and store visuals of each of your strategies. The most powerful feature for me is that you can easily link your trades from different brokers to your playbook so you can evaluate the performance of each of your trade setups across accounts. It automatically aggregates your net P&L, win rate, R multiple, and more for each setup. In addition to automated journaling, detailed reports, and in-depth insights, TradeZella features strategy backtesting and trade replay. I used to rely on 5 separate applications, but TradeZella has unified all of the key trading functionalities into a single platform. Whether you're trading stocks, futures, CFDs, options, crypto, or with prop firms, TradeZella is designed for both the independent and the professional trader. Visit tradezella.com and apply the coupon code Abdullah10 to receive a 10% discount. Let's get back to the episode.
So how does a person develop or just backtest their strategy, their ideas, their hypothesis to find out if it has positive expected
So I've done
value?
some really good videos on that. There's a couple ways. So backtesting is one. So I might have a simple strategy. Anytime there's a stock offering, I'm going to figure out how far it goes down. I'm going to figure out how far does it go down while holding a simple moving average. How far does it go down 1 hour later? How far does it go down 1 day later? How far does it go holding 2-minute bar highs or something? How far does it go using different types of stops? What percent of time does it work? What's my stop? And I'm going to test all these different variables. And I'm going to figure out, like, okay, if a stock has an offering, oh wait, no, actually in certain times this doesn't work. If it's a bond offering, this might not move. If it's a really big company, this might not move. If they just had drug data and everybody knows this biotech company needs to raise cash, it's already expected they're going to do so. So then you refine that and you say, okay, where the offerings really crush companies, maybe is in the low float space. Maybe is in the high flyers that really need to raise money, like a Rivian or like a Neo when those are super hot. Or take like the Nikola, which had been ripping. Or recently the PHUN, the fun, kind of that little ticker. And so then you say, like, you refine it even further, not just offerings, but I'm going to play these very specific ones. And you realize that when you crunch that data, the outcome gets even better. Then you're going to figure out, hey, if I do this moving average as a stop, my results are X, and maybe it doesn't work. But if I do this tighter stop, maybe it works really well. Or if I hold it for 1 hour, maybe it works even better. Or maybe if anytime the stock goes above the initial unaffected price, if that's my stop where I always bail rather than holding 1 hour, my data gets even better. And so that's one way, through backtesting. Another way is to forward test. And what you do essentially is you say, I'm going to short every offering with 1 share, and I'm going to follow these rules, and I'm going to see how that works. So the benefit of forward testing is you don't need historical data. There's times where historical data isn't so applicable. Take, for example, last year with the CPI data points, or I guess in 22. In 22, the CPI started moving the market big. The futures market, everything was moving multiple percents. You can't go back and backtest CPI data. It hasn't moved the market for over 10 years, right? And so that's where you need to immediately start either forward testing, or you need to start using just a logical hypothesis. And you might say, oh, wow, the market started to worry about inflation, and CPI coming in hot might show that we're in a lot of trouble. They're going to slow the economy. They're going to raise interest rates. And so even before the first CPI data point, if you're paying a lot of attention, you can hear this on CNBC. You can talk to money managers, figure out the theme of the market. And so even without a past historical data point or a forward one, you can still have the education and the knowledge to make that bet. Yeah. So there's a lot of different ways. Another way is, say you have a really good mentor. Say your mentor says, if X happens, I want you to do Y, and this is the rules for how you do it. You don't need to backtest it. You don't need to forward test it. You don't need to have a hypothesis. You're just following someone you trust. And so there's a lot of different methods to find edge, but doing some of those trumps all. And most of all, I would argue that, like, you need to be in the stuff that's moving. You need to be in the stuff that either has a lot of volume or breaking news or is doing something special, because otherwise a lot of the stuff is just noise out there.
So two important questions. So First one is, if you back test, what's a quality sample size?
Sure. So that's a good question. And so I'd like to just think about a lot of this stuff in practical terms. Let's say you back test something and it goes 5 for 5. How long do you want to wait? Do you want to wait for 100 data points? No, you don't want to wait. If we go 5 for 5, you might just put that trade on. And you don't need to go big. Maybe you just start putting on 1 share, then 100 shares, then 1,000 shares after 5 data points. But now let's say you go 5 data points and it only works 2 out of 5 times. And of course, keep in mind, we need to also factor in the risk reward, right? Because some trade might only work a quarter of the time, but if that pays out 10x, that could be a super amazing trade. So the other variable that I'm touching on is it matters the variance of the trade, right? If you have a trade that wins 99% of the time, but there might be major fat tail risk, like say, take for example, a casino. A casino, you're gonna win 99% of the time, but you might lose really big occasionally. You need to be really, really sure what those odds are and what that math is. So they might want a lot of data points because you're dealing with a lot of tails of the distribution and it's a different type of variance. So there's no perfect answer. So you might go 1 for 5, but you might win that one time. Say it's even just a little bit good. You're not going to give up on that strategy, right? You're not going to say, oh, this is a total waste. It only won one time. Let's say you go 0 for 5. Maybe you're like, damn, maybe this doesn't work at all, but maybe you get 10 data points or 15. You probably don't need 500 data points. Like if you've gone 0 for 499, the 500th data point offers less value, right?
Yeah.
And so it really depends the strategy. It really depends what you suspect the risk to reward is going to be on stuff like that. And what I would say is like, once you start to get a feel for the data, every data point incrementally provides a little bit less value generally. So eventually you get a pretty good feel like, okay, like most strategies say after 50 data points, like again, most, but there are exceptions. Yeah, you probably say like, okay, like, these won 30 out of 50 times. That's a 60% win rate. When it did win, it won 1.5 to 1. That's like a pretty solid thing. So I think after 50 data points, I'm aware of this. I'm not the master in this. I don't have 500 data points, but I'm going to start to put that trade on.
Yeah.
I'm not going to bet my whole account on any given one of them, but I'll bet $100, $1,000 and start to build it up from there.
Okay. So now the second question is building upon that one, because in the FX space, I hear a lot of people talk about how maybe they learn a strategy from a mentor and then it stopped working, right? And I think a lot of people in this space, their strategies are based on price action, like support and resistance lines, flags, pennants, and things like that, supply and demand. But when I learned like how like SMB trades and how you trade, there's certain underlying principles like in play, news catalysts that sort of like they take different forms, but the underlying principle of like what's moving or driving the market is the same. And I believe if you understand those principles, you're able to make adjustments. Like as you mentioned, like CPI wasn't moving, like for 10 years wasn't moving the market, but then now in 2022,
and how quick do you adapt?
How can you adapt if you don't understand the principles, right? So can you talk about that?
Totally. That's a great question. And I think the really good trader is very attuned to both and recognizing that there's value in both. So there's strategies I've done where fast forward to this day, I mean, these patterns have been the same forever. Certain patterns, like, I mean, my trainer started in like 2001, 2002. Those patterns, same as back then, exist now. I go back through my old charts and I'm going through some of my old documents. It is the same exact thing. And you just say, oh my God, if I knew then, like how I've refined myself over that decade plus since, it's just incredible. And so I think like there's stuff that is totally structural, right? Being the quickest to news is a structural edge. Having experience and knowing how to react to certain things, knowing certain patterns that repeat themselves, knowing that people will eventually be offsides and people will get liquidated, people will get margin called. Being able to, like, human psychology hasn't changed probably in 500 years, right? Since the beginning, whenever markets started, a tulip bubble or whatever else. Psychology has always been like that. People have always gotten euphoric. People have always panicked. And so a lot of those patterns always represent themselves. But then there's also the stuff that comes in and out of play or might just eventually structurally be arbed out. And so you could take something like the COVID cases in 2020. Every day people was following that number to know whether the market is going to sell off or whether it's going to be bid up. And that's not going to last forever. Obviously, that's still not in existence today, but that's a short-term edge, and there's nothing wrong with that. CPI last year, that wasn't going to last forever. People are eventually going to move on from inflation, but that's fine. That doesn't mean you don't want to capture it. So my point being with all this stuff is there's really two different types. None's necessarily better than the other, but the more important point that like, if you understand the framework of what drives price action and the perspective on this stuff, some stuff is structural, but a lot of the logic always exists. So take CPI, you're figuring out, okay, you're latching on to this is what the market cares about. The theme is this. I'd say almost every year, or certainly even sometimes multiple times per year, a market latches on to different themes. So last March, we had the Silicon Valley Bank crisis. So that was going to drive price action. What's really been driving the Qs nowadays? The AI move and the semis. So if you latch on to what these themes are, you can start to really get ahead of the curve and see some of those patterns.
So would you say that the market is mostly driven by like fundamental or sentimental themes
I'd say
rather
it's
than
driven
like structural
by a lot of things all at once. Like that's the beauty of something so complex. And like it can happen in different phases, right? There's times where the market's just totally driven by emotions and euphoria or panic, right? Think about in 2020 in March. That wasn't necessarily, some was fundamentally, like some of course is fundamentals, but then some stuff is just pure panic, liquidations, right? You had the GDX and GDXJ ETF totally diverge by over 10% from their net asset value. That's an ETF diverging from its NAV. So at times like that, no, that's just pure flows. People are getting liquidated. But then you have times when in a heavy M&A market, a lot of stocks are going to be driven by those prospects of M&A, and it's going to be super driven. So it's always a mix of everything. There's always players playing different games out there. And I think like that's why I always laugh when people always talk about this anonymous they. Oh man, like damn, they rigged that one good. Or man, like, oh man, like they just squeezed the shorts or like whatever they want to say. And it's like, okay, who is this they person? Like, let me tell you, like, I've met some really big traders. I've helped firms that are of the biggest financial firms out there. Like, forget the little day trading side, right? Like, I have friends at firms that the biggest institutions there are, and I know what they're doing and everything else. And it's like, if anything is true, there is no they. Like in every single stock, yeah, there's someone that might have a lot of float locked up in a certain stock or whatever else, but it's still a ton of different players making their own independent decisions. So there's going to be people that are taking that high a day stop. It's no some crazy algo out to get specifically you. There is no algo that says, okay, I studied this one retail trader's pattern, now I'm just going to try and screw them each time. It's like,
I think that's a big conversation in the FX space. Like there's some collusion and some big algorithm that was designed, coded, like one algorithm that's out there just wiping people out.
Yeah, like I don't want to talk, but about anonymous, spoofers and everyone else, but it's like, ooh, the algo driving the market. It's like, dude, I'm sorry, man. Like there is no algo driving the market, right? Yeah. Every stock has different players. And like, it's so funny, right? Because I've especially now on my personal account side, I trade much larger size, and there's been times and stuff where it's like someone's like, oh my god, like dude, like massive call volume or like massive put activity, or like, oh man, like did you see that order? Or like someone just like took that whole thing. I'm like, and they're reading all into that and like, oh man, and I'm just like, man, that's just me, It's like, and there's no crazy collusion, and like there's people that are trading the technicals. There's hedge funds out there that are saying, look, no matter what this does, by end of day, I need $5 million of this. There's people out there that are doing options flow, and there's people hedging that options flow, and there's people buying based on the fundamentals. There's people going with the trend, against it, all sorts of stuff. Like what might work for your strategy might tell you to buy when I'm selling on my strategy. That doesn't mean you're wrong.
Yep.
On your time frame and your strategy, you might win and I might win, right? Yep. So to think that there's like some crazy algo out there or anything else, like no, that's the beauty of markets. It's this mix of all these opinions and all these views being expressed.
Yeah. So a follow-up question to that. So if a trader is purely technical, if they aren't following what's happening with CPI, do you think they're at a disadvantage? Like CPI or just different things that's going on, like fundamentally or sentimentally, are they at a disadvantage?
No, I don't think they're at a disadvantage, because it needs to just be whatever is right for you, right? So if you don't have that skill set, like take something like reading the tape. This is always a big debate. And the issue is people are too quick to say just because they don't have any edge or skill somewhere, that doesn't mean it's impossible, right? And it's too quick to say that. And so many people say, oh, there's no edge in that. No. You don't have edge in that, and perhaps there's no edge, but other people might 100% have edge in that. And so I think if you're doing what's right for you and you're being true to your strengths and your skill set, I mean, there's people that have never interpreted a news headline in their life. Then I know people that they could care less about the technicals. I know people where it's like, okay, this headline, and there's certain strategies that I run. So I was mostly a technical trader. Like 95% of my trading was a lot of heavy technicals. But there would be certain headlines where I would know super high confidence how many percent that stock's going to go, like especially on M&A or like S&P ad deletes or like certain offerings where I had just studied enough in the news where it's like, okay, like I've got a really good idea. Like this headline is like a 10 to 12% headline. This headline's like maybe like a 15 to 20. This is a 30% headline. And so yes, I might make a technical trade, but then I might also have a huge chunk of shares just saying like, look, wherever this settles in, I'm going to take. Neither is wrong. And then there's people that could just be purely based on sentiment. At Traders for a Cause this past year, you had Jason Shapiro talking about, he does like the whole commitment of traders, like who's long, who's short. So you could purely base it on flows. But then guess what? I invest in with one fundamental investor hedge fund dude. He wouldn't know even what technical analysis is, but he's got edge. He's got edge, and it's just you all can win in different ways.
Yeah.
And I think people don't see that nuance. Like just because it's not right for you doesn't mean it's right for others. And especially on Twitter, it's not the best vehicle for nuance.
There's a big discussion about whether someone should specialize in one symbol, one asset, like maybe they're just trading Tesla or like ES or NQ only. Can you talk about the broken slot machine and like what perspective you lean towards and why?
I think like a really big thing just in life is anytime anyone says anything, whether it's on Twitter or anywhere else, there's a disclaimer at the end of every single thing. And what you don't see is there's a bracket for me and bracket. Hey, the keto diet is the best diet on earth. Oh my God, like keto works so well for me. Hey, I'm a vegan. I've never been healthier. Like being vegan's the best diet ever for me. Hey, the broken slot machine is what offers the best edge. Like this is where you find it for me. And in my case, for the people I mentor and I've worked with. And so keep in mind, like if you're running different strategies, like you don't necessarily need to find some of these things. Like if there are definitely strategies where it's stuff I'm not even aware of or haven't even thought about, and that's fine. But for the average day trader out there, in general, I truly believe that for most strategies, a lot of these tickers can be noise, unless you're kind of like the market maker, the HFT. A lot of this stuff tends to be noise. And where I know, me personally, as a fact, that things end up having massive edge is when, as I call it, the broken slot machine, something becomes super in play. There's fresh pieces of news, there's some type of catalyst, there's order flow, there's some crazy chart pattern, some stock is up 7 days. And like think about when Mara was making that super euphoric run to $33 or whatever. Like that's way more in play because you've got these massive ranges, you've got so much momentum, and you've got so much just range and volatility. And you've got the ETF approval news. So you've got all these different strategies that converge together to allow for a lot of different opportunities. And I would argue if you're spending those days sitting there the whole day training Sirius radio or something, it's like whatever works for you, of course. But if you want to just talk about magnitude of edge out there, like take something like that, like the AMC offering or even like the fun offering or some of those, or even any M&A headline. If you can be super quick to get some of those prints, the risk reward can be insane on some of that stuff, right? If you can be super quick to connect certain dots, like, oh my God, CPI's going to start to be in play. If you short a bunch of spiders, it doesn't move, you're getting out for a couple pennies, no harm done. But if that works and you connected the dots first, on that first time, you're making a couple percent, you're making dollars.
You made a statement on Twitter. I like to read it because the podcast is designed to like challenge us. This isn't to just offend anyone, but I thought this was an amazing statement and something that, we should think about in the FX space. So you had a tweet where you said, someone asked, is Forex any good to trade? Many ask about my view. In my opinion, FX is one of the most efficient markets in the way, more so than futures. Yes, a few succeed, but odds are very stacked against you. Only people making easy money from Forex craze are the Furu marketers.
Yep.
And then I think you put out a 10K wager, right? For anybody to come forward saying that they made like 250K 3 years in a row, like,
Yeah, any
like
of those marketers in the futures. And
yeah,
stuff.
in the future space, right? I think it was like 250 trades.
Yeah, and it might have
annually.
even been like 150K P&L. I don't remember, but the bar wasn't that high, whatever the terms were.
Yeah. So can you talk about, like, when you say the market is efficient, right?
Yep.
Can you explain this tweet a little bit?
So, and this is where a lot of people wade into this arena and they don't even have the basic education to be in the arena having the conversation. So asking what does this mean by efficient is an important first question. So efficient is not a word I'm making up, right? This is a word that has true definition and meaning in the academic space of markets. An efficient market, by definition, means it cannot be beaten. Like, as in, it is a random walk. The next move it makes is a 50-50 coin flip, 1-to-1 risk reward. It cannot be beaten. And essentially the same way the casino slot machine works out, pretty much 50-50. If anything, 49-51 against you because of the house wins in general. And I would argue because of commissions and everything else, by definition, again, not my definition, this is pure academia and the whole conversation of what this is, an efficient market cannot be beaten. That is one that's perfectly efficient. And now, obviously, things aren't perfectly efficient, but I would argue most markets are very, very efficient a lot of the time. As we all know, it is not easy to beat the market. We can definitely agree. So if it's not perfect, it's definitely not easy. We're somewhere in between. Then it's a question of how far. And so there's certain markets that I would argue are more efficient than others. And what I would say is the bigger the players, the more sophisticated the players, the more liquid the market, the less volatile the market is, the more efficient the market overall is. And if we look at, say, some markets are also extremely quantitative, for example. If I were to say I'm going to give you $100 a year from now, what's the value of that today? You simply take the discount rate, essentially time value of money, like, interest rates, whatever else, you discount it. So there are some things, or if I were to say, if I'm going to give you $5 right now, what's the value of this coupon for that $5 bill? It's $5, maybe discounted for any counterparty risk that I don't actually pay. But like, if we wanted to super simplify it, it would be $5. There would be no trading that. Nobody in theory would ever pay $5.01 for it. Nobody would ever pay $4.99 for it, because in 1 second, I'm literally giving you a $5 bill. So if we just understand some of this logic, there are some things that have super quantitative, like agreed upon prices. Now let's take the whole other side of the spectrum. Let's take something like Dogecoin or any of the crypto shit coins. What is the value of that coin worth? I have no idea. And these things are moving around a ton. And so the way I look at it, all those things I said, like more liquid, more sophisticated players, like the more news and price discovery, the better. So take an IPO, for example. You want to know what in general is going to move more than Sirius Radio each day? An IPO that hasn't traded before, because there's all this price discovery. So if I look at markets overall, there's some markets that are much closer to the perfectly efficient. Then if we were to take the other side of the spectrum, there's markets that are extremely inefficient. Like take for example, the market for certain pieces of art. There's a lot of difference of opinion. A lot of people might not recognize the value. There might be a lady out there that is selling for $100 $1 million painting, right? That's totally foreseeable. There is nobody out there selling like the S&P 5, like SPY, for $10 rather than what it's trading for. It's a super efficient market, right? And so what I argue with people is it's not that there isn't edge in futures. It's not that there isn't edge in Forex. But for the average person, it's just a more efficient game, and you need to be wary of that. Yeah. And I would argue with both futures and Forex, the reason why you see such a heavy marketing ecosystem to this online is because there's no PDT rule. So because there's no $25,000 minimum to actively be trading, that's why all those marketers move to that space. You get so many more people to suck into that game. And so what I would say is this is the same as walking into the casino. You need to figure out some games you're not going to win. They're too efficient. Like if I play slot machines, I am going to lose all day. But then there's also some games where if I play it totally correctly, I might have a chance of winning.
Yeah.
Like poker.
Yeah.
And so my important point is know where your market is on that spectrum. And that doesn't mean it's impossible.
Yep.
But like, look, if you're struggling, like I would argue that if you take something like Forex, not that it's impossible, but you don't have stuff like stock offerings happening every single day. You don't have stuff like M&A events. You don't have stuff like way less liquidation events, way less inefficient order flows. You don't have quad witching. You don't have index rebalances.
Yep.
And so a lot of this stuff leads to just a way higher opportunity set and a just spectrum of things. Like imagine playing a slot machine versus waiting around to play pocket aces.
And I like that point. And again, this is to challenge us to think, right? Because there's a company called Darwin X, and it's mainly targeting Forex traders. So you see people there that are making consistent money, right? What I believe is, and the people that I know, including myself, that have found edge, we're waiting on very specific times, right?
Very,
when the
very
market,
specific.
very, very specific times.
And I'd even butt in right here to say one of the key criteria in my Furu trader call out was not that nobody is out there making 150K, 250K, whatever I said, but it was against the people running these rooms that are saying, oh, these magic levels every single day, trading this every day,
Yep.
posting, just cherry picking their winning trades
Yep.
every single day. Because like, and don't get me wrong, there are definitely firms and there's definitely people out there that do trade it every day, but those people are probably playing with way different types of analysis. Like potentially there's definitely quantitative systems out there and all sorts of different things, or you're just simply like making markets, or you're like hedging flow and all this. But for this huge ecosystem to exist, it really meant to me that like, wow, 99% of this has got to be bullshit. And not that no Furu or any of these marketers ever make that much money, but like it was more so just like I want to see the proof.
Yeah.
And look, like I know traders like you, and I know so many futures traders that do really well trading futures. Yeah. And like I know people where they didn't do well at stocks and futures was the right market for them. But it's more so just the wake up call of buyer beware, and then there's just less edge out there than you think.
Yeah, and that's why I wanted to bring up the point, right? Because as I mentioned, I was born and raised in the Forex community. So I've been in different communities, and I see people showing up every day, trying to trade the same thing every day. So maybe they make money 3 months and then give it back the next 2 months, right? Because they're trading when it's not in play, right? So my challenge to the audience is really look at your playbook and really find out when, you know, your system is in play. If you're trading, you know, Forex pairs, commodities, futures, any of the equity indices, and really focus on those high quality times. And then maybe also expand your asset classes. Take that system on the road.
And I would even argue a lot of the concepts that I preach, and again, anything I say is parentheses for me.
Yep.
And then for the audience of anything, the question is there truth to this? Is there some principle that I can learn from? And then for the audience, it's parentheses, how do you run with this for you?
For you, yeah.
And so what I would say is these concepts that make something in play, you need to look at your market and say, when do these moments appear? When does this happen? So if we were to even take futures, there's times, right, like CPI where the market's super in play. There's times when different instruments are super in play. Like Nat Gas, the last couple years has made some wild moves. I myself, after one of my tweets, ended up trading Nat Gas futures the next day. Why? Because it was in play for me and what I was looking for. And so the point is like at the end of the day, one thing that is true is you do need, and this was another huge fallacy that people would make. No matter what, one of the huge signs of edge and opportunity is generally you need volatility and price deviations and ranges and moves. And so people online would then make the point, again, I would argue they shouldn't be in this arena at all. They would say the beauty of futures and Forex, though, is you don't need the big price moves because you can apply leverage. And that is because essentially, if you don't have a lot of edge, or if you have, keep in mind, if you have no edge and you apply leverage, what that means is in the long run, you are gone even faster.
Yeah, that's right.
It is a mathematical guarantee that if you have negative edge, you will be gone in the long run. If you double up your size, if you use 2x leverage, you will be gone twice as fast on average. 100% certainty. That's just math. Like, so that's why there's parts that's fact, and that's definitely just math, and that's indisputable. Now, keep in mind, if you have 60-40, 1-to-1, like so that's some edge. But then if you apply leverage to that, and the variance, okay, like you applied leverage, like to make up for the lack of range, and then you lose 4, 5, 6, 7, however many times in a row, you blow up again twice as fast if you're using 2x leverage.
Yep.
And so that leverage argument is a total fallacy, because you always want to find where the most edge is. Now, keep in mind, if you're doing 60-40 and applying leverage, the way better thing is no. Where do I get the most edge? So wherever that is for you, right? Again, I would argue there's amazing opportunities in equities, sometimes in futures, but generally when stuff is in play, if you need to apply leverage anywhere, it's better to do on the sure bet, right? Or the better bet. And so even that is a fallacy that people had. A dangerous one.
Yeah. So I want to talk about trading styles. There's a lot of arguments like in the space about swing trading being better than scalping or lower time frame trading. What's your style? I heard that you say you trade from the 2-minute intraday chart. Many would hear that and say, whoa, that's gambling. Trading from the lower time frame doesn't work.
So I think if I was like a little bit smarter, like if maybe I had like, like maybe like a couple Adderall binges or something, I can't mathematically prove this, but I do think this is like a true principle. I would say on the smallest time frames, sometimes offers the most edge. And the longer the time frame you go out, the less edge you have, but it comes at a trade-off of increased scalability. And so if we were to take certain examples I've seen in the intraday space, there's been order flow efficiencies. So take, for example, that GDX example where GDX broke from its NAV. Because I was during COVID, I would argue that opportunity lasted probably like a day, maybe 2-3 days. But a day at its peak. During normal operations, when capital exists, that shouldn't exist at all. If you're trying to wait for a monthly situation or a weekly candle or whatever, that opportunity is gone. And there's even smaller opportunities like that. Like, for example, somebody needs to puke out of some instrument, they go low offer and you're like, what the hell? Like, this is inefficient. And it's gone and it's back to where it should be. Like you'll see kind of like the mini flash crashes in little things each day. And those are micro inefficiencies that are immediately getting absorbed out. But guess what? If one ETF is trading minus 2% and the inverse ETF should be plus 2%, then someone accidentally spikes it to plus 2.5 or something, that immediately gets arbed out. But that is essentially free money, right? You can do a risk-free arb. And so my point with some of that stuff is like there's these micro things that have insane edge. And even with some of the breaking news, like if you take the, I don't know if you follow this stuff just given everything, but if you take the Spirit Airlines merger decision, so that was in a pending merger agreement at a huge discount. So the range of outcomes was if deal breaks, this goes to, I don't know, call it $6 to $8, $5 to $8. If deal goes through, it's trading, I don't know, I don't remember what the price would have been, but like way higher. And it was a huge range and it's trading somewhere in the middle. The deal ends up getting blocked. If you are the quickest person in the world to that news, there is nearly a 100% chance you're making money. You're risking pennies from the unaffected price, and you would have ended up making dollars. The expected value on that trade is so off the charts in that micro time frame. And so I would argue there's a lot of analogies and comparisons and examples I can come up with that. But guess what? That opportunity in some of these things is only lasting for a second, because the second that's out, it's gone, right?
Yeah.
And the more it moves, the worse your expected value gets.
What kind of size can you put on those opportunities?
Depends the opportunity.
Okay.
So there's some where they just aren't scalable. There's some where depending how fast you are in the liquidity, maybe you get 5,000, maybe you get 50,000.
50K like in
50,000 shares.
Okay. Give us some dollar amounts like for the audience to say, okay, from the 2-minute time frame, lower time frame.
On
How much?
some of
How
these
much
news
can you make?
headlines, like, I mean, there's people out there making. Of course, there's less liquid ones and more liquid, but
Well,
there's
for the
some
more liquid
headlines
ones.
you can make hundreds of thousands. I mean, there's going to be some headlines where you can make $1 million plus. I mean, think about the money on some of those CPI
How long
headlines.
does that trade last?
Could just be minutes. So take even a basic CPI, right? You can be going into the spiders, you can be going into the Qs, you can be going into Tesla, Bitcoin was moving on those. So think about how liquid those markets are, right? The futures market is, infinitely liquid on some of those plays as well. Not infinitely, but it's super liquid. Yep. And so you can make some really, really big money on that stuff. So
you're not just going into the market on the 2 minute and it's all choppy and you're just going in and trying to scalp something out.
You're finding the biggest moves with the most edge. That things
there you go.
You want to find the most volatile stuff. Yep. And so now I would argue, like, if you start to move out your time frame, like sometimes I'll do some swing trading where you're using the daily bar time frames, and now you can get a huge amount of liquidity, right? Because your stop is this big, and the play, you might be able to get around those prices for half an hour. And so there's hedge funds that might do that type of thing, and they're accumulating way bigger positions. But I would argue some of that is at the trade-off of edge. The variance increases. Like there's certain trades that I would argue have an easy 90% win rate. Some of those trades on the swing trading styles, like I find that to be, again, it doesn't mean they're not out there, but in my experience working with a lot of traders, I mean, I would say I've probably worked with, at least 200, 250 plus traders at this point. Like I've not seen anyone that matches the edge of shorter time frame trading.
So the shorter time frame, the methodology is higher win rate, right? A greater edge, lower, like you're in and out, but you have the higher win rate and greater edge, like in that specific time window.
Yep.
Right.
Now
it's not a 50% win rate type of strategy.
I mean, some might be. You've got the full gamut, I guess. But I guess at the more extremes on some of the really best trades, not in every trade, but the really, really best trades, I've not seen matched in higher time frames. Okay. But again, now think about it. Like, because there's so much liquidity on the higher time frames, like, if it would just be super, super nuts. Like there's certain principles around this of why this stuff does and doesn't work. And I'd argue that a lot of this stuff kind of gets somewhat arbed out on the bigger time frames. Gotcha. And for the bigger players. Here's like one of the final arguments I would make is like the returns of most day traders. Like, I mean, there's people out there like there's this guy I'm friends with, Ed Barry. He can take a 15K account and he can return 100% of that, no problem. No sweat off his back. He's profitable every single day pretty much. And I've known traders that are profitable. Even at Trillium, there's people that are profitable nearly every single day. Do you know a single hedge fund that's profitable nearly every day?
No.
There's trading firms out there like HFTs that are doing that, but they're on the micro time frame, right? Micro for thousands, millions of transactions a day. Now, if there's people like Ed Barry that can double their account on these shorter time frames, like that doesn't happen on the hedge fund space. What hedge fund is doubling their account in a year?
Man, this is incredible.
If you're even beating the market, most hedge funds, like 90% of hedge funds, that's kind of a made up stat. I don't know the real number to be real. Like they're not even beating market returns. No. Like the average Trillium trader, if you're a good Trillium trader, that's laughable. That's laughable. You're not even blinking at market returns, right? Yeah. If back in my prime, you gave me $100,000 account, that account is making money every single year, and that account's making a lot of money every single year. I'm not having any. Once I caught my stride, how many down years did I have? 0. I barely had any down months.
Incredible.
That's not true at the hedge fund scale. That's not true at the bigger time frames.
Yeah. So okay, now you talk about exponential bet sizing. I want to move into that because that's another underserved or underdiscussed topic, right? So can you just give us a little bit about like at what point can a trader look to start like betting more on maybe like the A setup? So like you mentioned A, B, and C setups.
The one key assumption is that this trader has the ability to differentiate between the quality of their setups. Meaning, as the poker analogy, can this trader tell which of their hands are better than others? Can they say, okay, this is aces, this is really, really good. This is jack, it's worth playing, but not gonna be the best ever. Or this is just not worth playing at all. So obviously you want to play those hands way different in poker. So there are some traders out there where based on their skill set and their strategy, it's all the same. It's binary. I'm either going to trade it or I'm not. There's no variables that I can predict that give me more edge than the other. Then there's traders like me out there with certain edge and strategies where it's like, oh my God, this trade might be so good where this is my aces. If you can differentiate, then much like any poker player, someone with aces or somebody with a royal flush or a full house or four of a kind, like they're not betting the same bet size. They're going huge on that. And again, like trading's a little bit different. You don't ever want to go all in or anything like that. But what you do want to do is have that scale in the bet size, because when your edge and your expected value is way cranked up, that can overcompensate for so many mistakes or different things. And that's one of the big lessons from my trainer that I learned.
So how do you recover? Like if let's say you take a loss on one of those big ones, how do you recover from then since you've increased the risk?
It sucks, of course. But I would argue, one, you shouldn't really start skewing it unless you're doing so prudently, right? You want to increase very gradually. The more experienced the trader, the more they can add skew onto their trades because they have more P&L cushion, they have more experience, they're more resilient to drawdowns. But what I would say is after that losing trade, you go back to your easy money playbook. And that's the beauty of having that easy money playbook. And the traders that I've seen grow the fastest, like there's this one dude at SMB Capital who's kind of on the younger side, but he's starting to really take off. And the people where when things really click, it's because they have their easy money trades, and those are their singles. And when they get into trouble, they're just back to basics, hitting the singles. But they then learn while building up that playbook to differentiate what are my aces. So it's almost like this barbell approach. I'm gonna shoot my free throws and my layups all day. I'm gonna just become the master of those easy layups. Then simultaneously, I am going to study and master the most important shots, like the big home run shots that I need. And so that approach gives you consistency and a cushion to then bet a little bit bigger. That doesn't mean go nuts. That doesn't mean ever go all in. But if your normal trade is 100, that might mean early on you bet 150. If you're a more experienced guy, instead of betting 5,000, that might mean 10.
Yeah.
And so it's doing so prudently and gradually, and most people kind of probably overdo it, but it's doing it safely and growing over time.
Yeah, gotcha. Okay. I believe 3 traders, like if we broke them down that are listening, and I normally start with the sort of like beginner trader, but I'm going to start in the reverse this time. So if there's a trader that, let's say they're good, they're making money, but they want to become great, what should they focus on? Like they're consistently making money, but they want to scale up and become a bigger trader. What would you recommend they focus on?
Yep. So I would always focus just going one step ahead. And so the number one easiest way to start to scale up, I would say, is find those easy money trades and start to be a little bit bigger in them. Don't worry about the home runs, right? Just build that bigger cushion and that bigger base. And so again, if you're normally making $1,000 or $100 in some of those trades, it sounds small, but let's say for the next couple of weeks, I'm going to add 10%, meaning I'm going to try to make 110. You know, instead of getting 1,000 shares, I'm going to get 1,200 shares or something. And what people underestimate is that can compound so quickly, and you're not having the psychological issue of, oh my God, like, because so often there's some people that can just flick the switch and turn the light on. Most people can't do that, and it's not easy because there's psychology, right? So the key is to never change your size so much that it starts to affect your psychology or your system. If you, instead of betting 1,000, if you bet $10,000, and that means you're taking a tighter stop or using the wrong stop or you're not holding your position, you're changing your whole system. It's too much now. If you're sweating bullets, or if that $10,000 loss is going to affect your psychology, no way, right? But if you just simply go 1,000 and you say, hey, look, I do 20 trades a day. If this $1,000 bet is 1,500, if this goes wrong, no skin off my back.
Yep.
You want to make those gradual changes.
Yep.
Now keep in mind, right? If you start to increase your size, that's a 50% increase, but that doesn't seem so big if it's one of many, right? But if you start to do that increase consistently over the course of a year, right? Even every 2 weeks, every month, that adds up big. By the end of the year, you're betting 3K, 4K, 5K.
Yeah. So now the trader that's struggling, maybe they're in it for a few years, they're independent, and they've invested time and money to courses and blown accounts, etc. What would be your advice for them to focus on?
Number one is make sure you're studying or finding a mentor or someone with real edge. don't, like, if you're sitting there for 5 years, and my heart goes out to those people, because I actually argue it's the majority of people. If you've just spent 3 to 5 years sitting at the slot machine trying to read into how to pull the lever, I'm sorry for you, but it was a waste of your time.
Yeah.
The only lesson you learned is, hey, I need to play a different game. And like, but if you're one of those people and you're ready to make the new leap, make sure you're sitting at the right game. Then ideally make sure you have a mentor if possible, or something where you know, like, okay, I know this isn't noise, I know there's edge. And then just focus on just anything that is just replicable and easiest for you and your strengths. And so that can be totally different for different people. I know one of our mutual friends, he has a very simple trade that he's refined. And like we spoke about, it's all about the nuances in the style, right? And so he found just in futures, a basic trade, it's a pullback to VWAP. And he goes long into that pullback. But again, it's not just that, it's all the nuances that he's refined, but that's his trade. And so for him, it works. He trades futures, it works. It's this very specific play, and that's scalable. And so for him, he's going to keep refining it. He's going to keep finding more of those, and that's the best path. And so I would say once you find something that works, the easiest thing is to find more of them, whether it's through software or through expanding your eyes out there with a pod, or then it's then to just size those up. It's finding more of your easy money trade. It's sizing up your easy money trade. That's always the best path.
Okay. So just wanted to give you some time to talk about some things that you have going on, like with your nonprofit. So can you tell people like where they should find you, like on Twitter, and then also a little bit about your nonprofit?
Sure. Yeah. So I have a nonprofit called the Impact Competition. And what we do is we host these university competitions that challenge students to solve local social issues. So we're probably at close to 10 schools, a dozen schools or so around the country, and we'll have students helping out the Houston Food Bank or Habitat for Humanity or Strides for Peace in Chicago addressing gun violence. And then the winner gets a cash prize. They get to fund these their ideas and implement them and make them real. And it's just a beautiful thing that I really believe in, and it's been super valuable to be a part of. And so people can check me out at impactcompetition.org, or they can follow me on Twitter at @the1LanceB, and that's where my real good content is always being dropped for free.
Yeah, man, this was an amazing podcast, man. I really appreciate you joining us, man. Thank you so much. I think I learned a lot, and I'm sure the audience got a lot of value out of this, man.
My pleasure.
Thank you so much.
Thank you for all the great questions.